This is the exact set of strategies we use on Option Samurai when the market turns red. And today we are going to share all our secrets with you for free, one strategy at a time. We will classify them by their risk and by the type of bearish market. When markets crash, most traders panic. They sell too late, buy puts too soon, and end up watching their accounts bleed red. The pain of losing money makes people act irrationally. But trading options in a bear market isn't about guessing. It's about having a system, a set of strategies working even when everyone else is losing money. Today, we will open up Option Samurai Full Bearish Market Toolkit for you. And as a bonus, we'll show you a cool bearish strategy for bearish markets with a great risk-reward ratio. The first step to staying calm in chaos is knowing how to turn falling prices into profit. So let's begin with the long put. It's simple, powerful, and often misunderstood. When you buy a put option, you're buying the right, but not the obligation, to sell a stock at a fixed price before expiration. If that stock drops, the value of your put rises. The further it falls, the more you make. As you can see from the chart, the main appeal here is the limited risk, combined with a potentially uncapped profit. The long put works because it flips panic into opportunity. When fear drives prices down, volatility spikes, and a growth in the implied volatility of the options market inflates the value of your put. You don't even need to own the stock to profit. It's like buying insurance on a company you expect to fall, and when that drop happens, your insurance pays out big. But no strategy is perfect. For instance, in this case, time decay works against you. Every day the stock doesn't move, your put slowly loses value. And if the implied volatility drops or the market goes up, your gains can evaporate just as fast. The most you can lose is the premium you paid, but that loss happens often if the timing isn't right. Now, let's see how you can find a perfect long put setup in just seconds inside Option Samurai. Head over to the predefined scans and click on Long Put. You'll find several ready-made scans built specifically for this strategy. Let's open this one. Weekly puts that will explode in value with a 1 average true range move. Here's the idea. You're buying very short-term puts that could triple in value if the stock moves just 1 average daily range. Notice how the scan only picks options expiring within the week. This is a fast, tactical setup designed for quick, leverage trades. And right here, you'll see a few opportunities where even a small dip could create a sharp, explosive profit. These are often inexpensive contracts, ideal for speculative plays when you're comfortable risking a small amount for the chance of a big return. And if you like this scan but wish to customize it a bit, you can always do it by clicking the duplicate button, edit the parameters, and even add new data points by clicking Add Filters at the top. Just remember, if the stock doesn't move as you expect, those short-term puts can lose value fast. Timing is key with this kind of trade. The second strategy in your bearish playbook is the short call, also known as the naked call. This is where you sell a call option without owning the underlying stock. Your goal is to profit if the stock stays flat or drops. You collect the option premium up front, and if the stock fails to rise above your strike price, that premium becomes pure profit. The short call works because time is on your side. Each day that passes, the option you sold loses value. This phenomenon is called theta decay in technical terms. And in a bearish or even neutral market, that can be enough to win. If prices drift lower or sideways, your short call can expire worthless and you keep the premium. But the short call isn't for everyone. If the stock surges above your strike, your losses grow without limit. There's no cap on how high a stock can go, and that's what makes the naked call risky. We don't recommend this setup for beginners, mainly because of the high margin requirements and the potential for unlimited loss. And by the way, we will soon show you how you can cap your losses by adding another option to the strategy. But for now, let's stick to the short call. You should think of it as a high probability setup with a high stakes downside. You'll need margin to protect against that risk and a clear plan to manage the trade. Let's see how to find a smart short call opportunity inside Option Samurai, using data to balance reward and risk. This time, we'll build our own scan from scratch. Start by clicking Compose New Scan. From the strategy dropdown, select Naked Call. Once the scan loads, you'll see results generated with our default settings for this strategy, but you can tweak them to fit your own style. For example, let's look for setups with an annualized return above 10%. And because short calls benefit from falling implied volatility, we'll filter for trades with an IV rank above 70. Now hit Run Scan and there you go. A full list of naked call opportunities ready for you to evaluate. You can fine-tune the filters again if you like, and once you've got a setup you're happy with, give your scan a name and click Save. That's it! In a few seconds, we built a personalized short call scanner that you can use to screen the whole market. If these tips are helping you think more clearly about bearish markets, hit like and subscribe so you'll never miss our next strategy breakdown. The next strategy we want to talk about is the bear put spread. This is a way to trade a bearish view without taking excessive risk. It combines two puts. You buy one at a higher strike and sell another at a lower strike, both with the same expiration date. By selling the lower strike put, you reduce your initial cost while keeping the ability to profit from a price decline. This setup is a debit spread, which means you pay a net premium up front, and your risk is limited to that amount. This strategy works best when you expect a moderate decline, not a crash, just a steady move lower. Because the short put helps finance the long put, you enter the trade at a fraction of the cost of a single long put. You can see it as a structured way to take advantage of bearish momentum while keeping your exposure small. Of course, the bear put spread has its limits. Your profit is capped once the stock falls below the lower strike. If the stock moves sideways, time decay will eat into your spread's value. And in rare cases, the short leg can be assigned early, something to watch for near expiration. But in that case, you can exercise the put you bought to remove the assigned shares. Still, your risk is always known up front. So this is a good approach if you have a smaller account, compared to one simply selling a call. Now let's jump into Option Samurai and see how to find the best bear put spreads. Go to the predefined scans section and select the tag Bear Put Spread. You'll notice several ready-made scans you can start from. Let's open one designed for a high risk-reward setup. Think of it as a small insurance policy for your portfolio. If the market drops, this setup can generate a solid profit. If it doesn't, you lose only a small amount, while your bullish trades continue to work in your favor. This particular scan looks for bear put spreads with a probability of profit above 20% and a risk-reward ratio over 500%. A great setup when you anticipate a downward move. Remember, unlike the short call we saw earlier, this strategy needs the market to actually fall, not just stay flat. And as always, you can duplicate the scan and customize every filter, from the spread profit ratio to the maximum loss, to match your own trading style. You can also add more parameters by clicking the Add Filters button. Now, let's see the next strategy. We told you earlier that you could turn your short call into a safer strategy with capped risk. So here it is. The bear call spread is one of the most popular bearish income strategies. It's simple, comes with defined risk, and works best when the market stays flat or drifts lower. Here's how it's built. You sell a call option at a lower strike and buy another call option at a higher strike, both with the same expiration date. The premium you collect from the short call is larger than what you pay for the long call, giving you an immediate credit when you open the trade. If the bear put spread was about paying a small debit to bet on a drop, the bear call spread flips that logic. You collect a credit instead. This time, you're not chasing a big move down. You're betting the market will simply not rally. As long as the price stays below your short strike, both calls lose value with time and you keep the premium. It's a quieter, more defensive way to profit, one that rewards patience rather than volatility. The bear call spread has clear limits. Your maximum profit is capped at the premium you collect, and if the stock rises above your higher strike, you'll hit your maximum loss. There's also the risk of early assignment on the short call, which can happen if the stock jumps quickly. That's why timing your entry and monitoring volatility are key to managing this trade. Now let's open Option Samurai and see how to find a profitable bear call spread. As you will see, it's very fast. Head over to the predefined scans and select the bear call spread tag. You'll see a few ready-made setups. Let's go with one that sells out-of-the-money call spreads, a conservative way to profit from stagnation or a mild pullback. Think of it as selling a call, but with built-in protection. Your profit is lower, but your risk is capped, which is a fair trade-off for peace of mind. This scan focuses on spreads above the current stock price with a positive expected value, at least 30% return on risk, and a safety margin greater than 2 times the average true range. As always, you can explore each trade in detail, adjust the filters, or even duplicate the scan to create your own version tailored to your market view. Before we move on, if there's another strategy you'd like us to cover next, drop a comment below and don't worry, we always read every single one. You've seen how to short calls, buy puts, and structure spreads, but now it's time for the hidden gem we promised at the start. This one is a butterfly strategy built entirely with put options to generate a highly asymmetric payoff. Instead of keeping the wings perfectly symmetrical, we intentionally shift one of the strikes. By adjusting just one wing of this put-based butterfly, we can reduce or even eliminate risk on one side of the trade. Let's see how it works. This small asymmetry is what makes it powerful. You still profit if the stock drifts lower, but your loss is capped, and in some cases, there's no downside risk at all. It's one of the few bearish strategies where you can aim for 500%, 1000%, or even higher profit-to-loss ratios without leverage or high margin. The key to success is that you want the stock to close near your short strike, not crash, just drift down and stay steady. It performs best in slow bearish trends or after volatility spikes that begin to fade. In other words, when fear is calming down, this strategy is probably a very good idea. Now let's jump into Option Samurai and see how to find these riskless down butterflies in seconds. Start from the predefined scan section, then click the tag labeled Butterfly. From here, open the scan called Riskless Down Put Butterflies. These are asymmetric bearish put butterflies designed to increase in value if the asset moves lower. They're a cheap way to express a directional view, often with an exceptionally high profit-to-loss ratio. This scan specifically looks for setups with profit on the downside, a break-even within 3%, and a strong profit ratio value. Notice the results are already sorted by profit ratio, so the most asymmetric trades appear first. Just remember, option prices move fast, so always double-check the prices with your broker before entering a trade. And of course, you can tweak this scan as you wish, like we showed earlier, to match your preferred filters and market outlook. So today we showed you 5 bearish option strategies, each suited for a different kind of market drop. Let's go back to our map. Again, remember, on the vertical axis we've got risk, from low at the bottom to high at the top. On the horizontal axis, the type of market, flat on the left, sharp decline on the right. At the top, you'll find the short call, high risk, high responsibility. It works best when you expect prices to stall but not go down by a lot. Then comes the bear call spread, a safer alternative that caps both profit and loss. In the middle zone sits the bear put spread, which is a nice idea in case of a steady downtrend. Go further right and you'll find the long put, a pure directional bet that can pay off big if you time it right. And finally down here, the riskless down butterfly, the hidden gem we promised. Low risk, high reward potential, designed for calm, controlled declines. Of course, this is not a definitive mapping. You could, for instance, sell an in-the-money call that behaves more like a deep bearish bet, requiring a much sharper decline to profit. The idea you should take away is that each strategy typically fits a different phase of a bear market. So the key isn't actually to be a master of prediction, it's more about matching your strategy to the right market decline environment. When others panic, you'll stay calm because you've already got a plan. Do you want to find these bearish setups in seconds? Option Samurai scans millions of trades and shows you which ones fit your plan in a very simple way. Sign up for a 14-day free trial and start trading with confidence, not panic. And if you like this breakdown, check out our next video to learn more about becoming an options trading samurai.